We did see gold go above $5,000 US an ounce again, with dip buyers returning to a choppy market. Let's get more on the latest performance for bullion from Rebecca Teltscher, portfolio manager at Newhaven Asset Management. Rebecca, great to see you, and thanks for joining us.
Thanks for having me.
I mean, the proverbial roller coaster, gold, a lot of money, I guess you could say a lot of money has gone into gold, and perhaps buyers are scarcer now.
Yeah, it's so funny. I was on vacation last week in Mexico, and I had very spotty internet, so I wasn't, as up to date with the markets. And wow, what a week to miss, right? What we saw in, commodity prices, whether it was gold, silver, the markets. I mean, we saw a lot of volatility, particularly in the metals, and that translated to the TSX. And now, we're seeing a little bit of a reversal of that as gold, goes back above $5,000 after, dipping below that last week.
Mm-hmm.
At the end of the day, gold is, a neutral asset. And what we're seeing is, as investors are taking money away from risky assets, whether that's going to be the tech sector, which we saw last week, whether that's going to be Bitcoin, that's down 20% just year to date, and whether that's going to be away from the US dollar or treasuries. They are searching for a safe haven, and right now gold is one of the only areas that's providing that right now.
Of course, gold highly volatile itself, though. I mean, I guess there's no safe haven in investing ultimately. Maybe government bonds come close.
Well, the thing is, government bonds used to be a safe haven, but, as we're seeing all these government shutdowns, as we're seeing, debt levels climb to record highs with U.S. deficits, not coming down. I think we saw that at least last year, the spread between corporate bonds narrowed, not because corporate bonds were trading at, a discount, meaning that the economy is okay, but it was the opposite. We saw, a premium for the yield, like the yields of government bonds going up because investors were worried that the U.S. won't be able to pay back their debt. So as you say, there is no risk-free asset anymore. And with interest rates coming down, I think that's, creating more of an opportunity for places like gold.
Those tech stocks, I'm just looking at the list of big stocks in America hitting 52-week lows this morning. Adobe did its lowest in at least a year. Salesforce and ServiceNow. So those three names, classic software names, all under pressure again, certainly in early trading.
Yeah, I mean, software has its own issue with the idea that, AI can take over some of their business. But even with the large hyperscalers, like what we've seen with the Magnificent Seven, those stocks really outperformed in the past, for the past 2 years. I mean, since the introduction of ChatGPT. And, it's a new technology. I get it. It was really exciting. I do think AI is here to stay. I'm not questioning that. But now the question is, okay, we've seen now several years of what AI can do, but how is that going to translate into revenue? And so, what we saw last week with earnings is, Amazon is spending $200 billion in CapEx, in 2026. Google's spending 175, Meta's spending 115 billions of dollars. I mean, these companies that were asset light are now becoming very asset heavy. And, we don't invest in that sector because it's a little bit too risky for us. Valuations are too high. There's no dividend yield, to support the stock price. But if I was an investor in those stocks, I would absolutely be concerned at how much money is going into the sector without any indication of how this is going to translate into revenues or income growth.
Yeah, it's interesting. I mean, you're calling it a race to the bottom. It's kind of a mirror image of a race to the top, isn't it? I mean, they are spending more and more. And I am curious. I mean, $200 billion by Amazon. So they're obviously thinking, well, we'll earn $200 billion in profits here. But from what? Who's going to pay them $200 billion in earnings? I mean, consumers are going to pay.
I mean, and that's why we're seeing Amazon stock really under pressure. I don't think investors are necessarily buying it. Google's a little bit odd because they're, spending almost as much as Amazon, but they seem to be getting like a free pass with the market. Like they haven't seen the same share price weakness that Amazon has, and perhaps they're showing more of a translation into revenues from that CapEx spend. So I think right now, whereas in 2023, 2024, any company that was investing in AI was, receiving a very high trading multiple. I think now we're seeing not necessarily reversal, but I think, when you're trading at a very high premium or a very high multiple, you're priced to perfection. So you better deliver perfection. And I think what we're seeing is if you're not, or if investors are questioning where all this CapEx is going, you're going to start seeing some weakness. So I think, 2026, I think investors are looking under the microscope. They are paying more attention to where this money is going and if that's actually going to translate into growth.
That's interesting. I'm not sure if you saw that Anthropic, the AI provider, says we're not going to be putting ads into the answers that we provide people. ChatGPT, Sam Altman is upset about that because it looks like ChatGPT would like to bombard us with ads.
Right. And this brings up another point. There are many different AI tools right now. At the end of the day, in 5 to 10 years from now, how many AI bots do we actually need? Yeah. I mean, I think we saw it 20 years ago. Did we actually need more than one search engine? Did we need Yahoo and did we need Google? No, probably one search engine is enough. And so similar to AI, how many do we need? Google's and AI and OpenAI and Anthropic? How many different AI tools do we actually need, or do we really need to consolidate under one? And if that's the case, then all this CapEx could be for nothing.
Yeah, that's interesting. Yeah, I guess specialists will always have their special type of AI, but you and I maybe not. Yeah, that's
exactly.
Interesting. Yeah.
And so, like I say, AI is here to stay. I'm not questioning that. I think we see it's a powerful tool.
Sure.
But for us, for our investors, it's just not a risk we're willing to take because I do think it's still early on. We're seeing lots of capital going into this sector with with a lot of questionable results right now. And maybe eventually this will be a good sector to lead to. But right now, without any dividend growth, with high multiples, it's just too risky of a sector for us to go into right now.
Thanks very much indeed, Rebecca. Rebecca Teltscher of Newhaven Asset Management coming up.